So no company or industry is immune as market sell-off continues. US futures are in the red. That's an indication that Wall Street will open in negative territory. Now, analysts say there are multiple drivers of markets right now, including fears about stock valuations, concerns about a weakening U.S. economic outlook that could be exacerbated by the prolonged shutdown of the U.S. Congress. To speak to us further about this, we're joined on the line by wealth specialist at Rand Swiss, Viv Govender. Good to be talking to you once again, Mr. Govender. Welcome.
Thanks for having me.
So how much of the current sell-off is driven by fears of a weakening U.S. economic outlook? And I ask this in comparison or versus concerns that the Federal Reserve may delay interest rate cuts.
Yeah, look, I mean, we're getting the first bit of data on that on Thursday, where we have U.S. Non-farm payrolls, which were delayed because of the shutdown, the government shutdown. I mean, people weren't being paid, they didn't go to work, and they didn't obviously collect the data that needed to be collected. I think that that's partly it. So there is that question about global, weakness. But I think also what's been happening in the past little while is we're seeing fears about AI, artificial intelligence. People may not realize the kind of bet the world has taken on artificial intelligence over the last couple of years. It's actually bigger than the bet people took on, subprime mortgages back in the day that caused the financial crisis in 2008, if you remember that. It's almost 20 years ago, but it was what caused the great financial, the global financial recession. You know what I mean? And that is, I think, looking at the current situation, the amounts of money being spent here are actually larger. And I think that's one of the fears out there is that if you look at the US, half of US GDP growth this year is pretty much attributable to AI. You look at the stock market, over 80% of the US stock market improvement this year has been due to AI-related stocks. And so that could be something that maybe people are thinking that they could be a bit overdone at the moment. And we also see news that people like Peter Thiel, for those that don't know, Peter Thiel, if you watch the movie The Social Network, he was one of the guys that invested in Facebook. He's a big time investor. He's actually South African, or has a link to South Africa. And he basically sold his stake in Nvidia, as well as his stake, or reduced his stake in Tesla, as well as another famous investor, Masayoshi Son from Japan, who basically runs a company, a fund called SoftBank. And SoftBank sold out their Nvidia shares as well. So that makes people think maybe the smart money thinks this is overdone.
Mm. So are AI tech store valuations fundamentally justified? Or to your point, is the market pricing in unrealistic growth expectations that perhaps could also be prolonging the sell-off?
Look, I mean, I did an analysis on this just the last couple of weeks, and the numbers are shocking. I mean, to give an idea of how much money the U.S. companies are spending on AI, it's like $400 billion in the next year is planned to be spent on AI infrastructure. $400 billion. To justify this kind of spend, like a company like Microsoft doesn't take the full value of what it creates. It takes about maybe 5% of the value of what it creates. If it's spending $100 billion, that $100 billion has to create more than $2 trillion of GDP, probably like $3 trillion of GDP for that $100 billion of investment. $3 trillion is roughly the size of the French economy, the whole of France's economy. And Microsoft is just one company. Meta is doing similar. Google is doing similar. Alphabet, Amazon, etc. And all these guys up to it's $4 trillion. For that to be value, you're looking about maybe something in the region of about say 3 to 4 France's worth of growth, and then has to be created to justify this kind of investment here, and that's a lot of money. I mean, France is one of the largest economies in the world, and we're talking multiple Frances. We're talking something like half the size of the U.S. economy. In terms of GDP, has to be created by the investments these companies are taking in this year alone.
So what does the simultaneous decline in traditional safe havens like gold signal about overall investor sentiment and liquidity conditions? Because it's a completely different trading market, a completely different investing market. AI, as you've mentioned, having skyrocketed and taking the lead.
Yeah, look, I mean, if you look back at the global financial crisis back in 2008, again, I'm using that as a reference point because that'll be the last thing that people remember. When that occurred, gold was not a safe haven. U.S. bonds were not a safe haven. There was no safe haven. Everything fell. In fact, one of the places that didn't fall, strangely enough, was South Africa, as much as at least the rest of the world, especially our banks stayed really strong during that period compared to the rest of the banks of the world. But if we do have a pullback like this, it will not be a case of safe haven in gold or a safe haven in Bitcoin or a safe haven in many things, because historically we don't really see that occurring. We do, we look back and look at the gold price, when things really, really go bad, you don't really find gold, being as stable as people would like it to be when, people are nervous about everything.
Could gold once again reestablish itself as that potential traditional safe haven? After all is said and done, it's almost like let the new kids on the block come and do what they will, but the old faithfuls will remain.
It could. I mean, there's arguments to be made that, that the being of the gold standard in the 1970s, which was about 50 years ago, is basically always going to lead to the situation in which fiat currencies, which is currencies not backed by anything, are going to inflate themselves, to valuelessness or to high levels of inflation. But as yet, we have not really seen that occur. Though, if you look at it, we are seeing Europe, the US, Japan, most of the developed world basically is entering a period where the demographic situation is going to result in huge pressures on those economies. I mean, I saw a stat recently that is amazing. Since 1990, basically incomes have stayed. This is talking like people that earn incomes like salaries and so on in Spain has stayed pretty much flat, but pensions have increased by like 90%. They almost doubled in that period of time. Where people, who are actually working have not gotten an increase, and most of Europe, the rest of the developed world are in that situation in which they have these huge pension deficits that are going to be, having to be sorted out. And in that scenario, usually what happens, money printing occurs, and that usually leads to devaluation. So we do find, if that does occur, that people are going to go to safe havens, be it gold, Bitcoin, or whatever they may think is something that's going to maintain value to that period of time.
Viv Govender, thank you so much. Great insight there. Viv Govender, wealth specialist at Rand Swiss.
Connecting Africa to the world.